Okay, so just to set the scene quickly and to remind everyone, we ran a 2-day workshop on Saturday and Sunday. It was all around knowing your numbers. And this is all about starting the year strong. So it's really, really important. If you want to start the year strong, you need to know what your numbers are. It's something that we do at the mastermind level in terms of the whole plan with the family office, which I'll share with you later. My question for you as well is that as you go into this year, and what are you thinking for this year? You know, do you want to kind of have the same sort of year as last year, or do you want to get out of your comfort zone? And this is sort of where you're in your comfort zone, and this is where the magic happens. And I think this is the point. So not only today are we going to go into where the market's going and what can you do about it, but also just as a person, what are you going to do to really do something different this year to get to where the magic is? I do want to recommend this book. So at a mastermind level, we've actually studied this book, and it's going to be my single sort of focus for this year. 10x is easier than 2x. And the question is, how do you apply this in your life, your business, and your wealth strategy? So we're going to be implementing this at a mastermind level right across the principle. There's 10 different frameworks upon which you do. And I would strongly recommend, if you haven't, reading that book. It's an incredible book in terms of that overall process. But without further ado, you cannot make good decisions if you don't know your numbers. And secondly, if you don't understand where the world is going in terms of the major trends. So Garth and Anthony, it's wonderful to have you here. It's always a privilege and an honor to be in partnership with you. And you know what we do at the mastermind with the collaboration between ourselves and yourselves is something I'm deeply grateful for. And we starting off the year with as usual with a bit of excitement. Donald Trump doing his usual antics to keep us all on our toes. But what I've basically done is I've put together some questions here to give people an idea of kind of where we are in terms of the world markets. What do we need to be looking at? And I think just in case anyone doesn't know, Garth is the co-founder and CEO of Calio Capital. They're a family office. They manage about 65 clients. It's a multi-family office. And Anthony and Garth work very closely together. Anthony, I'm not 100% sure exactly what your title is, but you guys are basically a team in terms of the process. I know Anthony looks after all of our mastermind, or most of our mastermind clients, and people only have great things to say about what Anthony does. I think Anthony, help me with your title. What is your title exactly?
Associate partner.
Associate partner. There we are. I didn't want to get it wrong. So, but it's wonderful to have both of you here. And again, just a reminder that generally you would need to have tens of millions of dollars to be part of a family office and to get access to this type of information. So for all of you who are online, it's wonderful to have you here and to be able to get access to this information in terms of where we're going. So I don't know who wants to answer these questions, but let me start quickly. Or before I go, anything you want to say, Garth or Anthony, just before we rock and roll?
Yeah. Oh, you go, Ant.
No, I was just going to say nothing from my side, but thank you for having us, Scott. It's good to be here. Good to be with your community once again. Thank you for having us.
Awesome.
Yeah,
thanks.
I just want to welcome everybody and wish them a prosperous year. You said, are we going to do what we did last year? I'd love to do what we did last year. It was a fantastic year. This year might not be as attractive, but I'll take last year. Thank you. But yeah, welcome everybody. I hope it's going to be informative and that we can help you make some good decisions.
And just a shout out to you, Anthony. You became a father on the weekend. So on behalf of all of us, firstly, congratulations. And secondly, thank you for being here. You've got a whole new chapter ahead of you, which some of us know what you're in for. So anyway, good luck.
Thank you, guys.
Anyway. Okay, so let's look at the first question here, which is a macro regime shift. So what do you believe are the most important macro regime shifts underway as we move into 2026? And which of these do you think the average investor is underestimating or misunderstanding? So, basically, Garth, you talk a lot about the big shifts and everything else, but what should people be looking at when it comes to shifts and what's happening in the markets?
Well, I just wheel spun in from Cape Town here, and that's why I was slightly late. But so I mean, we're just having a very frank conversation here. I think you guys like to refer to it as a fireside conversation, but it's 30 degrees here, so the last thing I want is to have a fireside conversation. So we'll have an aircon conversation, to coin a different phrase. Macro shifts. Protectionism, I think. If you look at the macro shift from what was really just driving markets historically, would be your interest rates, your inflation rates, your macro shifts to political interventions into, price wars, tariff wars. Those macro shifts are making all of the headlines. So I think people need to be aware of that information and its effect on the markets. So I think the biggest macro shift in 2026 is going to be that one of political. The stock standard macro shifts in interest and inflation. I think Anthony will talk to those numbers, but we see interest rates coming down. We see inflation targets not yet reached, but getting there. So those are incredibly important. I think people are also potentially creating more fear around the markets. And whilst that's not a typical or a historical macro shift, I think people have become quite sensitive to information and making decisions around that information. Whereas when you actually look at the fundamentals and the macroeconomics, our asset allocation and our view might surprise quite a lot of people with all of the geopolitics and things that are going on in the market. So I think not so much to, speak directly to that, but just to set the tone of what we're going to talk about this afternoon. Ant, you want to add to that?
Yeah, I think it's a good place to start. I think maybe looking at what happened in 2025 is a good proxy for what's perhaps to come next. And I think, as Garth said, we saw last year there was a lot of headlines, right? There was a lot of events going on. There was a lot of geopolitics. If you kind of cast your mind back, it was a very busy news flow year. I wouldn't be surprised if papers and magazines had record sales last year because the headlines were weekly. However, if you remove that and you look at what markets did last year, pretty much every single index globally ended in double-digit returns, right? Whether you look at that in base currencies, whether you look at that in US dollars, you had a really, really strong market year in 2025. Again, that's S&P, that's all the European indexes, that's emerging markets, you name it. Everyone did exceptionally well. So what that tells you is one needs to be very careful around paying too much attention to the noise and letting that derail your objective or your investment path. I think it's very, very easy to pick up your phone, go onto Facebook, go onto Instagram, go onto a news website, and really just see the worst the world has to offer. So
hang on, Ant. Let me just
Margie, just mute yourself.
I'm going to mute everyone, and then if you guys can just unmute yourself again. Cool.
So yeah,
I was interested in Margie's conversation.
Hey, listen, God, you're not going to believe this, but 3 times I've had someone get dressed on, undressed, sorry, on stage. So,
well, I'll never forget. We had a webinar, and one of our clients, it was a Calio webinar, and this client, unbeknownst to him, being on camera, quietly opened up his first beer, his second beer, and by his third beer, actually fell asleep in the deck chair. In the middle of the meeting with everybody watching. Anyway, sorry, Anthony.
No stress. So yeah, I think that kind of taking stock of what happened in 2025, understanding that it was a busy news flow year, but markets were still able to produce some really good returns is a key kind of part of the thought process. And the reason why I say that is because this year is going to be no different. I don't think the next year is going to be any different either, and nor do I think the following year is going to be any different. That would mark the 4-year presidential term of Donald Trump. I don't think you're going to have this kind of quiet, contained year. I think one needs to start getting very comfortable with geopolitical noise and events happening on a macro level, right? The key is trying to determine of that noise which is meaningful and what isn't, right? As an example, we had the US invade or storm into Venezuela, take the president hostage essentially, and fly him back to the US. I mean, that was major news, right? That was across every single newspaper and magazines, and everyone was reporting about it. The reality is it had little to no effect on market. There wasn't even a blip in markets. So using that as an example, one mustn't get overly caught up in that kind of news flow and let that derail in investment decisions, right? If you're a long-term investor, you've got to stick to your knitting. You've got to have confidence in your holdings, and you've got to see the course, right? I think this year more than ever is going to be about diversification. Right. I think it's a word we use a lot. It's a word, Scott, you guys use a lot. And it's always been important to have diversification when investing. However, I believe over the last 2, maybe even 3 years, you've actually got away with not being overly diversified. Right. You've kind of swerved a bit and you've dodged a bit, and you've actually come out on the other side quite nicely by not being overly diversified, right? Look at the S&P 500 as an example. If you were just invested in that index over the last 3 odd years, you would be smiling, right? There would be no issues. However, I think going forward, for the first time in, like I said, in 3 years, where you're not just riding that magnificent 7 wave, diversification is going to become very important. We saw glimpses of it last year. Some of the European indexes ending up higher than the S&P 500. We saw that rotation into European equity early on in the first quarter of 2025. That did stall a little bit, but it picked up towards the end. And ultimately, the returns generated from that first quarter were enough to kind of propel those indexes through the year and end them pretty much on the top spot. So I think that is going to be incredibly important in 2026. I think from a kind of drilling down to a market perspective, I think you see more of that rotation. When I say rotation, I don't mean a kind of all-out collapse of the US and everyone kind of pulls their money and moves into Europe, but I think you see a kind of gradual trimming of profits and reallocation towards more global strategies, more highly diverse strategies that have Europe in them, strategies that have some emerging markets in them. And I think that diversification, along with other kinds of asset classes, which we'll get to later on in the questions, private equity alternatives, things like that. I think one needs to be building a robust portfolio that can weather these geopolitical shocks if and when they come. There will be ones that are just noise that we've seen, but there could be some real ones. There could be some real market moving events as well. I'm certainly not saying that all geopolitical events are merely just noise. I do think there will be ones that cause volatility in the market, like we saw last year, middle of March to the first week or 2 of April. People were very, very quick to forget that the S&P 500 was down negative 19%. It almost crashed. At negative 20, the S&P 500 would have crashed in 2025. So kind of keep that framework in mind. Keep that diversification in mind. You might think you're diversified. Make sure that you really are. Make sure you understand what you're allocating to. Make sure you understand why you're allocating to it, and maybe kind of try to dig one layer deeper. Maybe try make sure that your underlying holdings are not all identical. Right? You've got to make sure that you're well positioned.
We'll talk to portfolio construction a bit later because I think it ties in with exactly what you're talking about there. Tell us, Anthony, in terms of inflation rates and inflation and interest rates, etc., where do you kind of see them going over the next 12 to 24 months? Garth's already alluded that it's starting to the inflation's starting to kind of get in back in track, etc. But what's your prediction on both interest rates and inflation, and then also what does that mean in terms of the markets in general?
Yeah, sure. I'm actually going to quickly share a slide. I think it talks really nicely to that exact question. It's actually a very similar slide to what I shared last time, except slightly updated. And it really kind of gives you the lay of the land of what the forecasts are looking like. Now, the caveat here is that these are forecasts, that they're seldomly to the T accurate, but it gives you a good idea around the kind of general thought process and the thinking of the market at the moment. So top left, inflation, starting at what it was in 2024, 2025, in the middle block, and 2026 in the next block. You can see United States. Let's ignore the first line, world at the moment. United States for 2025 coming at in at 2.7. Inflation was released a couple of days ago, weeks ago, and it's pretty much sitting at exactly 2.7%. So the US is getting inflation under control. Their ultimate end goal or target is 2% for inflation. It's going to take some time to get back down there, and they might actually need to get a bit more comfortable with slightly elevated levels of inflation, but it is coming down, and the expectation is for that to come down further. You can see there the rest of other countries, Eurozone, Germany, UK, everyone in general is getting to grips with inflation and getting inflation under control, right? That leads us into interest rates, and is obviously important for interest rate decisions. What I've got on the top right there is some of the guys on the call will be very familiar with these, but it's one of my kind of favorite indicators to understand what the probability is, or what the market's thinking around interest rate cuts. And that is the expectation for the next Federal Reserve meeting in about 8 days' time. And what that's telling us is, at the bottom, you have the current interest rate in the US. It's hovering between 3.5% and 3.75%. And the probability of it staying like that, i.e. no interest rate cuts, is currently sitting at 95%, which is obviously incredibly high. And then the probability for a 25 basis point cut, the line above that, is sitting at around 5%. So the likelihood of an interest rate cut in the next couple of days in the US is looking quite slim. The reason for that is the Fed just adopting a bit of a wait and see approach, just understanding what the data looks like, not being in too much of a rush to cut down and realize that they've got a bit ahead of themselves. So I think it's an important step. But I do think we see interest rates come down after that. I think you might see another cut at March's meeting and April's meeting. They'll likely take a month or two, January and February, just to assess the data, wait for some more information to come in before making that next decision. Very interestingly, the chart below that is not updated. This is from about two, three months ago when we last had this discussion. What's interesting there is to see just how accurate those forecasts are or have been. And everyone is pretty much right on the money. So if you look at the first one, the US, we're probably we're 25 basis points off. We likely won't get to that 3.5 by February 2026, but still on track to kind of be at 3.25 by May of this year. And that would assume that there are two more interest rate cuts in March and April. Eurozone sitting comfortably at 2%, unlikely to cut further. They seem to have things under control. They were front runners in interest rate cuts. They were ahead of the US. They started earlier than the US, and they seem to have things under control. Another topical one, the UK, they are currently right on target there. When we last looked at it, they were sitting at 4%, but they have cut since then, 25 basis points. So they're currently sitting at 3.75. And they may have room to cut once, maybe one more, once or twice this year, but likely another interest rate coming for them. And then you can kind of see the rest of them. Switzerland sitting at 0. Again, they were front runners in interest rate cuts. They've cut all the way down to 0. They are very, very reluctant to go back into negative interest rate territory. So I don't think we'll see that out of Switzerland. But what you can kind of gauge from the general sense of it is there are interest rate cuts. There are a couple more to come. And as a general rule of thumb, interest rate cuts are positive for equity markets. They reduce the interest that one can earn on their cash. And in doing so, it kind of ushers people that are holding cash back into the market. Also think of it, if you've got credit cards or you've got debt or you've got things like that, you're paying less on your debt. You've got more free cash flow at the end of every month. Less of that cash flow is being absorbed by interest payments. And the thinking is you've then got more money to go out and buy things. You've got more money to invest. You've got more money for goods. And as you purchase things, that stimulates the economy, and that's good for equity markets because at some point, one of the businesses is benefiting from that expenditure, and it's going down to their bottom line. That's the kind of
Anthony,
general thinking. Yes.
Chaz, just touch on South Africa as well, because there is I mean, obviously it's a global audience, but also just if you can give the South African equivalent numbers and view very briefly for the South African audience.
Yeah, sure. Sure, you're catching me off guard. Yeah, I think South Africa's at about 725, if I'm not mistaken. We have cut quite a bit as well. Definitely still on an interest rate cutting trajectory. South Africa as a country has actually done exceptionally well. We've gotten rid of our Eskom issues, seem to be somewhat in the rear view mirror. We are running some really, really strong trade surpluses that we haven't seen in quite some time now. That is pretty much all as a result of the increase in commodity prices over the last 12 to 18 months, being a big commodity exporter. That really helps us. And we've been a benefactor of a weakening US dollar. So that also helps us. It helps our imports. And yeah, we seem to have inflation under control. The South African Reserve Bank is pushing hard to change their inflation target. It still currently sits between 3 and 6%. It's a band. It's not a fixed number. We're very much on the lower end of that band, hovering around 3%. And Lesego Kanyanga has been quite vocal around wanting to create a fixed target at 3%. So removing the band and targeting the lower end of that band. Like I said, we're achieving that, and because of that, it puts them in a position where they can comfortably cut interest rates.
Awesome. Garth, in terms of capital protection, we talk a lot about this in terms of...
Oh, we're not finished. I mean, that was a wonderful sermon that we had there. I thought we were done and dusted with. Okay, sorry.
It was a very good update, Anthony. I do appreciate it. So in terms of capital protection, in an environment of heightened volatility and uncertainty, how are family offices thinking about capital protection versus growth? And how is that balanced from previous cycles?
I think the biggest difference in capital preservation of multifamily offices, versus a lot of the sort of individual investors is the absence of, alternatives, specifically hedge funds, structured products, and these sort of defensive equities that we use quite regularly as significant allocations in the family office portfolio buildup. And these instruments are available. So direct property, defensive assets, structured products that are able to deliver a benchmark return in a volatile market with very, very definite downside protections. And then hedge funds, which are able to make money in muted markets on both the short and the long situation in the market. So capital preservation techniques like this, we always concentrate on minimization of taxation. And certainly those three classes that I just spoke about, which are very underutilized in individual portfolios, but highly available, to the public market now.
Why do people not get access to more of that? Again, I go down the road, I go meet my financial advisor. Why am I generally not getting access to what you're talking, the different array of assets?
Um, because I think, certainly in the South African market, the advisors are often unaware or don't have access to this. A lot of this stuff comes from the international markets where family offices are focused on, all geographical allocations and, all countries. So I just think the family office reach um, is where these things are bought because they're readily available and readily educated on it. I think also the pricing of a lot of these things has also been prohibitive. And, I think in the past, organizations haven't done what you've done, where you've been able to sort of fractionalize access to this, or family offices like a multi-family office being able to make these available through cumulative and, combining smaller investments to make up bigger pools. So I think that's why they haven't had access to it. It's not inaccessible. I think that gap is closing, but these are preservation techniques, and certainly I think they haven't been available because the barrier to entry, both in the quantum to enter it, has been extremely high. And the guys looking after the family office haven't typically needed to go to the public market to capitalize these alternatives, private equity, and the hedge fund space. These things are often capped. So yeah, it's about getting access, I suppose.
It's interesting. I mean, I know Chad's online, and when you take structured notes, when I originally started talking to Chad about structured notes, I think it was $2 million minimum or something to get into a structured note. And now, obviously, as you say, with tech and whatever, there's much more accessibility, just in terms of that process. Garth, there's a question here from Mike. He said, "Can you give some examples of defensive assets?"
Okay, so defensive assets. Yeah, I mean, let's take somebody. I mean, there's two scenarios. One, you're never out of the market. That for me, that strategy is timing the market versus having no plan and have time in the market. All right, so that's the first part. So defensive assets for us, if we're sitting, in a market of heightened volatility, and as the market sits, the S&P 500, forward PE is 22.5 at the moment. I mean, that's a pretty expensive market by, historical terms. So in a situation like that, our approach for a defensive asset would be strong dividend yield, but still capital appreciation. So we'll move away from the highly volatile, high growth sectors, and we might look at a defensive asset which is strong in dividend yield, less upside in the capital, and off we go to the races. And we're pushing a 4 to 6% diversified currency dividend from that. So a Swiss basket, for example, other European baskets, certain baskets in the US will be able to deliver these returns without doing it. Another great example, mentioning Chad, these guys do release notes that are appropriate. So when you look at a defensive asset, you're always looking at what risk am I taking for what is available on a forward-looking market this year. So Anthony and myself, as we go into our full strategy for the year and our positioning, we might differ in terms of what we think this market's going to deliver. So if I take something like global equities, I might be quite neutral in terms of global equities now, and my prediction for global equities would be around 8 to 10% this year. So when we look at that, and that's not to say that's what it's going to be. I'm just saying, if you look at the PEs, if you look at not being diversified, if you look at the dollar position and how markets and, having it correct, you can do better than 8%, sure. But a diversified product, for example, in that would be something that can deliver 12% with a lot more certainty. So that's a defensive asset. What risk am I taking to get a return? So as we see a structured product, hitting our emails in our relationship with Cashbox and Chad, we see something that is offering that type of yield, but is also offering you a downside protection to get that return. You're not automatically going to take the volatility of the markets, and that's an example of a structured product. An alternative asset and a fixed property asset, we have a closing out on a deal now. Let me give you an example of that. Our annualized return on that will be around 14% in euro, but we've got a very underlying strong property in Germany. We're redeveloping that property, and our predictions and our case study on that is quite certain. So it's a defensive asset. It's going to take a bit of time to do that. So that's an example of a direct property rather than a listed property, where I would say listed property we're quite neutral on, and I can only see a 6%, hard currency yield out of listed property as a neutral return on that. So that's a defensive asset. Hedge fund, as I explained, there's lots of hedge funds in our arsenal to be used. We've got very experienced, very old, long-term hedge funds that we use, and these are capable of protection on the downside. So those are three very real examples of defensive assets, four actually, including the Swiss type dividend ETFs, where we focus on yield to pick up and less capital return. Happy?
Yeah, perfect. There's a couple of questions coming in from France and Connie and Alan, but I'm going to defer them to the end, basically. So let's run through the sequence. If a question is relevant to the current topic, I'll do it, but otherwise I'll bring it up at the end. Okay, Anthony, in terms of risk, where do you believe risk is being mispriced today, either underestimated or overestimated across global markets and asset classes?
Sure, it's a tricky one. I think perhaps risk with the news flow and the geopolitical events that are going on is maybe even overpriced at the moment. I think everyone is quite nervous. I get that kind of underlying feeling that most people that I speak to have a kind of nervousness about them. And I think if you kind of, again, you cast your mind back to 2025, the start of 2025, it was a similar rhetoric. It was a bit uncertain. Kind of had 2022 had two good years, in 23 and 24. A lot of people were happy that Donald Trump was coming into presidency. A lot of people were unhappy, and there was a lot of fear, uncertainty surrounding the market. So I think there's a risk that people are being overly cautious. Markets continue to trend, and the momentum continues to push markets upwards. I think a key point to understand is going to be this Q4 earnings season, which has already kicked off. Earnings seasons are always good to get an idea as to how businesses are running, how they're doing, what the bottom line's looking like, what's profitability and revenue looking like. So I think that's going to be a very important couple of days, couple of weeks to keep eyes on. Some of the US banks have already reported. They've reported good numbers. It's largely been quite positive so far. There have been some upward revisions. The banks are typically used as a proxy to understand how the kind of general market is doing, how the man on the street is doing. So I think that's one kind of risk, is another upward surprise. Do I think it's going to be plain sailing this year? Certainly not. I do think we are perhaps due some kind of volatility event. We were taking a bit of profit. We were taking a bit of money off the table towards the end of last year. As Garth mentioned at the start of the meeting, it was a strong year. So we're just being kind of prudent, taking a little bit of profits here and there. In preparation for a potential volatility event over December, Jan, over that kind of Christmas period. We didn't see it. Markets largely traded sideways and have been doing so to an extent since. There's also been some pressure on markets this evening. But I do think at some point in time we see some kind of volatility, some kind of, call it maybe a reality check, based on valuations, based on those price earnings multiples Garth referred to just now. That could likely come. But I think you see market participants use that as an opportunity to get rid of this cash that's burning a hole in their pocket and re-enter the market quite quickly. I don't think you see prolonged downward market pressure for months and months on end. I don't think you see a market crash either. I think there's too much money on the sideline that's looking for a home, and there's too many people actively participating in the market at the moment. Obviously, that's bar some kind of black swan event or some major kind of geopolitical issue. But I think we hear a lot of noise, we see a lot of noise. There's the usual volatility and uncertainty. But I think the risk is missing out, right? Especially if you've got objectives, you've got targets to meet. If you've done a life aim and you're aiming for certain returns. I think one needs to be careful of being too prudent and actually or too scared to enter the market and kind of shooting yourself in the foot as a result of that.
Look, the only thing I'll add with Donald Trump, he's likely to do something within a quarter that does at least give a small discount here and there. He's a guy that has very strong actions, and that often does lead to discounts. But when you hijack and collect the president from Venezuela and it doesn't move the market, you got to start scratching your head about what is the black swan that really moves the needle. But just to add to what Anthony's saying, I mean, to talk to specific things, there's a big thing around AI and bubble territory and all of that. And I mean, we've said this before, but I think people must understand the difference between the valuation of a company and its earnings. Okay. And I want to talk to this because this is really the biggest driver of growth markets. And when at one point it started to look like we were starting to mimic the dot-com crashes of 2000 to 2001. But there was a big difference. The valuations of the tech companies in the dot-com crash didn't have the earnings to support those valuations. So now when we look at these tech companies, the actual revenue is supporting that valuation, but it doesn't mean there's no risk. And the risk lies in how the tech companies are pushing out depreciation. So it's keeping the revenues up and showing their profits to be slightly elevated. The second thing, as we've spoken to, and it's becoming very old news now, is this revenue flowing between these big tech companies. And just to talk in layman's terms, this is where you say, are there any risks that we should be careful of? I think you've got to be careful to miss the long-term value of AI, biotech, and the trend. But we do believe there's a better entry level. So that's a very different statement to exiting it. We don't exit markets. We're neutral, underweight, or overweight. At the moment, we are underweight tech to see exactly how that plays out. But we're not out of tech completely because that can hurt you. I deal with some private equity funds coming out of a very well-known university, alumni, and some of the stuff these guys are doing. I mean, the revenue potential of what some of this stuff is doing is just absolutely mind-blowing. Its adoption is so early stage. So the long-term view remains bullish on what we're seeing in the AI trends, but we do feel that this market can have an entry level that is better. So let's argue the fact that, let's say I see 10% this year, but I also see at least a 5, maybe a 7% blip in the market with all of these risks on the table. And that would allow me to play into that market if my plan's in place and I don't now get scared when I'm down 7, and deploying that capital into that, giving myself a great start to my cash deployment in that. But I'm underweight cash. I'm looking for opportunity. I'm underweight bonds. I'm looking for opportunity. And I think that's important. Another very topical asset class is gold. And has gold run too hard? Is there still value in gold? Gold, when the man on the street is nervous, gold, when he's sitting with potential wars, trade wars, it's a safe haven. It's a typical hedge. But we caution again. It's the same as any other equity. It's got the ability to fall hard when the shift to risk on goes back. So with gold and any asset class, this is where it's very important to understand. You never have an exclusion. You have an asset allocation. I would say gold should always and can always occupy space in your portfolio. but I would be very neutral on gold with the current prices well into the 4,600s, etc. But it can still serve a purpose. So an allocation to gold, if you've never had one or don't have one, yeah, it's expensive, but it's still got a hedging capability, and in the right proportions remains an asset class that you should have in your portfolio. But it doesn't give you yield. Okay.
I think one extra thing I'll add, and it's just worth keeping in the back of your mind, is that there are midterms. US midterms are in November. So I think we see, as we start to get closer and closer, I think Trump starts to behave better and better. I think he might wind his neck in a little bit as we start to get closer to US midterms, because he'll obviously want to make sure that he retains all the seats and things like that. So it is worth keeping in mind that this is a midterm year as well.
In terms of, Garth, you've sort of referred to this already, but and maybe Anthony, this is for you, I'm not sure. But in terms of global liquidity and capital flows, where do you kind of see opportunity? And you've already kind of alluded to it, Garth. So I'm wondering if we've covered it already. But is there anything else in terms of global liquidity and capital flows where there's opportunity and or stress that we need to be aware of?
Yeah, so I always say capital flows should always come to Calio Capital. That's my standard response to capital flows. I think we've answered it around capital flows, but I'm happy to talk to capital flows and maybe slow down a little bit on what I was saying about asset allocation and our positions on that. If that will help. So capital flows. I'll give you some views and projections. Let's very quickly touch locally. South Africa, for everybody that's international, you can just get yourself a glass of water, crack that beer or two, and off you go. So local equities, we're positive. I think local equities. I think we're confident that SA Inc. can deliver 12%, but I do think, taking the view on the rand over the year, I think it's likely that the rand is not going to disappoint nor excite. I think there's a 3% on either side of its current level ending the year. So, that said, I'm really telling you this because I think with that view on the exchange rates, I would be confident to go to the bigger global market where your bigger alternatives and various are available. Bonds neutral, seeing a return of 8 to 9%. Listed property in South Africa, neutral to slightly overweight, 10%. But I think the general equity market will be a better place to be. Cash negative on that, hovering 7. And there again, I say I'm very pro on capital flows into the alternatives. I'm very positive on the capital flows to the markets in the 4 areas I spoke about early. And I believe those are quite capable of delivering 10 to 15% with a risk-adjusted return. So private credit, private debt, the alternatives, hedge funds, structured products. Okay, the offshore, the global equity, we're neutral, tending towards bullishly comfortable, momentum comfortable. And we do believe quoting a US dollar return, we might struggle, if not diversified, to see a double-digit return, but I do think we can see 2 times cash at least. So if cash is at 3 to 4, I do think we can see 8, nearing double digits if the tech sectors, the Nasdaq, doesn't disappoint. Government bonds negative, we anticipate around 4%. Corporate credit negative, we see around 5%. Listed property neutral, 6-7%. Hard currency return, cash neutral to underweight, 3%. And the alternatives, as I spoke earlier, positive, where I believe with the volatility we'll be able to extract 10 to 14%. And on property, like the German property deal, 12 to 16% in euro, with yield. And then also, private equity plays. We've got a great secondary deal now where we believe you can do 2 to 3 times money. and we've got a fantastic business that we're going to make available now as well. Those alternatives, because of their income or dividend yield, plus their cash, plus the dividend ETFs, we believe those alternatives are where a lot of the space for cash flows need to go into, if not yet exposed to those markets. And that's our position in terms of that.
I think you've pretty much covered the next question I had, which was the strategic asset allocation. I don't know if there's anything you want to add to that, Anthony. It's pretty well covered by God there, but I'm just wondering if there's anything you want to add to it.
No, all good. Happy to jump to the next one.
So in terms
Again, for
Yep.
you guys, Scott, just before we move off that, okay, because we always assume everybody knows what we're talking about. There's two types of allocation, okay? Strategic allocation is where you have X amount in a global market. Okay, so when I spoke to this global equities and neutral, etc., remember that most of your return comes out of equity markets. Okay, which equity markets to buy? There's 11 subclasses to equity. That's where professional advice comes in. But tactical asset allocation is how much you just have in that class of equity. Tactical asset allocation is where you make the selective picks of which of the 11 classes. Now, strategic asset allocation will never change, will account for upwards of 85%. So get your strategic asset allocation right and leave the tactical asset allocation to the diversification experts and really take your time with that. But just the strategic asset allocation is going to give you 85% plus of your returns over the long term. Okay.
Cool. I probably should have said this, and I'm going to say it now just in case. Obviously, between ourselves, both companies, we're doing our best to educate and inform people. We're not giving, financial advice over this. That's where you would sit down in a one-to-one environment. Okay, from a geographic perspective, Anthony, which sort of regions and countries? You've spoken already a bit about America and Germany. Do you want to talk a little bit more about that? Because I remember having a conference similar to this 2 years ago, and Garth and you were talking about how the euro is expected to increase in value against the dollar and etc. And that's happened to some extent already. Where do you see the geographic sort of areas to be looking at, and what should we be looking at for this sort of next cycle as we go into this next couple of years?
Yeah, look, I think that euro strength relative to the dollar, or maybe let's call it dollar weakness, because that's what it largely is. A lot of that has happened. I think last year was a big year for dollar weakness, euro strength. Do we see that continue? I think like Garth said with the South African rand, I think you maybe see a bit more dollar strength, but I don't think you see the numbers that we saw last year. I don't think you see kind of between 10, 12, 13% dollar weakness or euro strength. I think that was a kind of knee-jerk initial reaction. I think you see a kind of more normalized numbers going forward. Remember, these are two huge developed market currencies. This is not for the South Africans. This is not rand dollar where you can see kind of those huge fluctuations fairly easily. So I don't think we see any more of that. What I do think you see, back to my earlier point, is I think you see some rotation out of the US. And I think you see a lot of that capital making its way into Europe as well as emerging markets. I think that is going to be a trend that continues, and that is something that everyone needs to make sure that they have exposure to. I think again, talking to that theme of diversification, I think this year it's going to be more important than ever. Europe, Switzerland, there needs to be some kind of exposure there, as well as some exposure to emerging markets. Drilling that down a level, maybe on a sector level. Still seeing good value in healthcare as well as financials. For some of the guys that were on the last call, you may recall that industrials were also up there. Industrials subsequent to that webinar that we had a couple of months ago have actually done exceptionally well, and they've been moved back down to neutral. But healthcare and financials still looking good. Don't get me wrong with this shift between US to other developed markets and emerging markets. I've said it before, and I want to say it again because it's very important. It's not a case of dump everything and move somewhere else. It's just a case of trimming profits from a holding that has potentially done well and making sure that you're reallocating and rediversifying that exposure elsewhere. I still think you see certain parts of the US market do exceptionally well. Will we have another blowout technology year where tech stocks are leading the charge? Probably not. I think they've done a lot of the heavy lifting for some time now. I do, however, think that within that kind of broader technology basket, you still see some standout performers, right? There is a very, very intense AI race going on at the moment. All these guys are clawing and biting each other and trying to be number one. They're trying to be the kind of be all and end all in terms of the value add, the value creation chain around artificial intelligence. But as you know, thousands of people can't win the race, right? There can be benefactors of it, but I think you'll see over time. I don't know if this is in the next year, 2 years, 3 years, maybe even 5 years, 10 years. But I do start to think you see kind of new winners starting to emerge in the AI race. So again, perhaps a more targeted approach, a slightly less aggressive approach, but making sure that you still have some exposure there. Nasdaq is a good example of something like that because you typically pick up quite a few of them. You're spreading your bets. No one knows who the next winner of AI is going to be. So again, important to have that diversified exposure, but within moderation, right? And that's where you would be perhaps looking to trim a bit of profits, allocate that to Europe or Switzerland or emerging markets. So I want to drive that point home. It's not a case of baby out the bathwater, not allocating to the US. I think just make sure that you've still got some exposure, but you are well diversified elsewhere.
Perfect. God, this is an interesting one, and I know you talk a lot about this. One of the things I learned from you is entrepreneurs, business people are often very good at kind of business, but often it's the complete opposite things that they've succeeded in business kind of impact them when it comes to investing. So this sort of question is an interesting one. How do you help people distinguish? And Anthony's already spoken about the noise. So we see it in the press and your mates are talking, whatever. How do you help people distinguish between the short-term noise and what are the long-term signals in terms of when you're actually trying to position this capital?
Sure. We're ending at 8 o'clock tonight. All right, let's break that question up. So obviously, first of all, macroeconomics drive markets. Micro trends, wars create opportunity to really make opportunistic returns. So that's the first thing. Macroeconomics. Always watch how much money does a person have in their pocket. That's Trump's catchline, right? That's how he gets the voters. I put money in your pocket. I reduce taxes. That's what 340 million people really care about. So, that's first and foremost, is to understand the macroeconomics drive markets. What we're experiencing now, whilst it feels new and interesting, and that, this has never happened before. It's, industrial revolutions felt far more significant than the AI revolution at the time. So it's very important to know that this has all happened before, and it will happen again, and you've got to capitalize on having a plan and going forward with that plan quite clearly. The second part of that question, just give me that again, Scott.
It's mainly a psychology thing between understanding and helping
okay, sorry, yeah.
clients, distinguish between the noise and the real stuff,
Yeah, so yeah, I would use much stronger language when talking to entrepreneurs trying to be investors, because you're quite subtle. I just say, they're terrible bloody investors. Entrepreneurs, they go in and they build a business over 20 years and they exit for a few billion. And it wasn't easy. And, there were ups and downs, and they had staff and lawsuits and everything that goes with business. And after 20, 25 years, they exit and they go, right. Then they become investors and they go, well, why am I not making 100% a year? They forget the cycle of business is exactly the same as all of the cycles of the businesses listed on the markets. So that's the first thing, to explain to people that there are no get-rich-quick schemes, okay? There are markets and there are a range of returns that those markets can deliver. There are opportunities outside of those normalized returns, but you only have a band of returns that for 120 years of data and forward-looking has driven the markets. And on that, we construct a plan. And once we've got that plan, what we really focus on is return to time relationships. So when you have a pool of capital, how much time do you have to create financial independence? How much stock do I have to grow in order to have capital and financial independence? And in the absence of a plan, you're going to hit nothing. That's a guarantee. Without a target, you're going to hit it every single time. And with that, to throw out another very important thing, investments, and I've said this before, like a bar of soap, the more you play with them, the smaller they get, okay? And this is critical because once you have an investment plan and you have done that investment plan, it requires maintenance, not a complete reconstruction. If it requires a complete reconstruction, it wasn't a plan. So you put that plan into place, you tweak it, you maintain it, and you build on that plan as things change. But a plan takes that history in. So when the market crashes, when the market goes down, when the market corrects, that has been factored into the plan. What do you do when markets do that? You go and play golf, you go fly fishing, you go do whatever it is you do. Okay, because that is factored into the plan. So there's nothing new in the world, okay? And whilst it might seem we've got these tensions which are incredibly high and fake news might be read by somebody and you go into this, there are realities and these realities need to be understood. Yes, there is increased spending on defense. That's protectionism I spoke about. These are cycles. We've had periods of high tension before. We've had periods of Middle East unrest before. I do think people are a lot more informed than before, so we get a lot more knee-jerk reactions, but it's incredibly important to understand that our job is largely to build the plan and keep the behavior correct. So we develop a lot of tools around understanding behavior. And I think that's the only way a person can sleep at night, because if you're going to wake up to your Instagram, Twitter, Facebook, and every other form of news feed that you get, you're going to go nuts. And I do find people with a plan don't phone us when there's sort of irrational stuff going on. And I think you must also understand that a lot of what is going on in the world is part of the trade war. It's part of the pricing tariff war, just in a different form, to create cost to energy, to even the playing field. So, it's good to have a plan, and it's good to have a sounding board and an advisor that is incredibly rational and is incredibly well researched and understands why you've got that plan and why that plan is your plan, not his. Okay, because some people just, no matter how much a plan is put in place, just cannot tolerate being down 25%. Okay, it's an emotion that is akin to a 7-year-old in a shopping center not getting a sweet. It's not rational when you're in that position. And we identify that with various tools, and we do this across the family office with members of the family, and how to run proper investment boards and not have a single person sitting with a responsibility on their shoulders. And that's what investment committees are for. That's what mandates are for. That's what personal plans are for. And that's what a financial advisor that's worth his salt is for. Okay, is to keep the sanity. Sorry, I got quite motivated.
No, it's brilliant. It's brilliant, because I think that's, we're talking a lot about some of the sort of macro finance stuff, but actually the psychology stuff is as important. And, Anthony, I know
more important.
More important, to be fair. Anthony, I know you talk a lot about it both at our mastermind and at the wealth weekends. What are some of the kind of common mistakes that you see people make And I mean, Garth, you've already sort of answered it already as to how the family office mitigated. But I mean, are there any other mistakes that you would look at, Anthony, that Garth hasn't mentioned?
Yeah, I think before I answer that, one thing I'd also add to what Garth was saying is the Enneagram of wealth, and the kind of realization that gives you about yourself, as well as the information that it gives us around how to manage that behavior in those kind of stressful periods. I think that's incredibly helpful for both advisor as well as yourself. To answer your question, Scott, I think there's two typical bad mistakes. I think the first is selling as a result of panic. I think that's probably the single most costly mistake. We've shared the charts numerous times. Most people know exactly what I'm talking about. But when you look at time in the market versus timing the market, time in the market is going to win every time. There is so much data pointing at it. I unfortunately don't have those. Oh, there we go. Scott's sharing the screen. There is just no denying that selling at a bad time or selling due to fear or panic is going to hurt you, right? You get that 1% out of complete luck that managed to time it correctly and get back in at the right price and benefit from the upside. But it is so few and far between. So I wouldn't be trying to time the market, nor would I be selling out during periods of volatility. And again, that goes back to behavior. That goes back to a relationship with the person that you trust and the information that they're feeding you to make those decisions. I think if you want to go a little bit further down, Scott, I think so that's a good example. It's quite small.
I'll share this. I'm going to put this in the chat for everyone just as a gift. And it was a white paper that I put together based on what Anthony shared with our mastermind around timing the market. So I'll just share it as a gift with everyone in the chat room.
Yeah, cool. You guys, have a look at it. It will make a lot of sense. And it really just shows you two things. It shows you the power of compounding, as well as the importance of not trying to time the market nor sell out during periods of panic. Remember, the worst days in the market are often followed by the best, and that is the key risk, right? The risk is that you sell on the worst, you miss the next day, which is the best, and you start that whole kind of journey on the back foot. So I would say that's probably the number one risk. I think
let's just show very quickly what you're showing here. So this just so people can, when they get, I've put it in the chat room already. But in simple terms, this is in the high and the low of every market. So like Garth mentioned, or Anthony mentioned, last year was down by 19%, but also ended the year positive. Then this is showing if you'd invested since 1979 to 2024, and if you'd literally, been invested the entire time, so $10,000, if you'd been invested the entire time, you would have $1.7 million. If you'd missed the best 5 days, it would be $1 million. If you missed the best 10, it'd be 700. If you missed the best 30, it'd be 200. Is that 274? And if you missed the best 50, it'd be 120. So that's what he was just talking about in terms of market timing. And then the other thing that was really interesting is that depending on how long you're in the market, if you're in the market for 10 years, you've got a 97.4% probability of making money. Obviously, the shorter the amount of time, the more risky it basically gets. So I just thought I would share that. So when you get it, you know what it's all about.
Yeah.
I want to briefly expand on that. More money is lost due to emotional decisions. I mean, we talk about market timing and that, and a lot of guys like traders and that will advocate market timing. That's a very different game these oaks are playing. They're day traders, but money is lost from emotional decisions. Okay, one, fear when the market is high, and that is what you should be experiencing. And that's where you should be taking a little bit off the table. And then greed as well. When the market is high, people suffer from greed. It's there's this plan and this the simple understanding of behavioral finance and people's attitudes to money. And this is why we've actually spent the bulk of our effort. I mean, we know we can make the returns. I mean, that we've proven. But why we spend so much of our time at Kelly on the behavioral side, on this Enneagram of wealth, because it's not okay to have a client where you say, but I've told you this, and the client still behaves in a certain way. And this is what we were talking about. If we understand how that person processes information, if you're not receiving information in the correct way, it will fall on deaf ears. Okay. So that's critical for me. And that's why we've spent a considerable amount of time understanding that and how a person reacts to fear and how a person reacts to loss. These are things that are really the critical elements of why people lose money and why families lose money and why generations after inheriting wealth are bankrupt. It's all behavior. It's not intellect. It's not investment decisions. It's investment behavior.
So
I think
what is the
Scott, just to add one more thing there. I mean, in reality, you are very likely to make these kind of mistakes if you don't have a proper plan in place, right? The plan for me is already step one of kind of coaching the mind around that kind of behavior, right? I think a lot of people take comfort knowing that there's a plan in place, knowing that they've got an objective that they're trying to achieve. And realistically, if you've got a plan in place and you are in equity markets and the markets go down, there's a reason why you're in equity markets. And the reason for that is because based off your time horizon, you can afford to be in equity markets, right? You can afford to see out that volatility. Your investment time frame is likely the same or longer than average market cycles. And the reality is that at that future date, when you need to become reliant on your capital for income, you should have an adequate amount of time should have passed so that you're no longer in a position where you're forced to draw down on capital that has experienced the market drop, right? That rotates, that shifts. When one moves into retirement, it's a different way of planning. It's making sure that you have liquidity to service your monthly or your annual income requirements, and that capital is not linked to markets, so that you will never find yourself in a position where you're sweating bullets, markets are down 25%, I'm forced to sell because I need the income, right? That's poor planning, right? So again, the behavior side can be combated. You can be more prepared by having that plan in place, right? If you kind of eyes closed throwing darts at a dartboard, you think you've got this great plan and this great portfolio, but markets come and there's volatility, and all of a sudden we're stressing. It means that the plan wasn't that good to start with. Right. So I think there's key steps that can be taken leading up to the actual investment of capital to put a lot of those fears and anxieties aside and already start to explain and show why one doesn't need to behave badly in periods of market volatility.
So I want to just share something. There's a couple more questions, and I'm conscious of the time here. You've both spoken about the wealth EQ and planning and everything else, and I've got some slides that I just want to share quickly. So give me 5 minutes or so, and I'll take people through it, and then we can come back to the final question. So you've spoken a lot about people wanting results. We all want results, but actually it's all the stuff below the iceberg: the emotions, the values, the assumptions, the bias, the judgments. And what's really interesting is that 95% of people are in this away state where they see threat, they're withdrawn, they're fearful, their inability to make good choices, they're demotivated. And the whole intention here is to be in a towards state. So happy, ability to think clearly, creative, see new opportunities, etc. There's only two ways to be in a towards state. One is you get around like-minded people, and two is you get very clear on the outcomes. So this is what Anthony's talking about with a plan. Like, what are the outcomes that you're actually trying to achieve here to be able to achieve it? And so I just want to share with you quickly, there's a little video I want to share with you here. And it's a beautiful video in terms of actually helping you achieve and get your results.
No, this is extremely predictable. There's tons of research around it. Humans
But
change
just on the screen.
5 times faster.
What's that, Alex?
Just swap your screen.
Oh, sorry. Thanks. We've seriously got to fix this. My 2 screens are different on 2 different laptops. Okay, let's just try it again.
No, this is extremely predictable. There's tons of research around it. Humans change 5 times faster in groups than they do with a one-on-one coach, consultant, or therapist in that case.
Wow.
So I started looking back at business models and people who had done this effectively over the generations. Masterminds aren't new, folks. They're not new at all. People have been doing this for thousands of years. And when you put a collection of people together who are all committed, all driven, and all so want to make the right changes happen, and you give them a leader to follow who's willing to get in the trenches with them, all of a sudden you start finding real, rapid life or business transformation.
You know, what he said there, if you look at it, is, you know, humans change 5 times faster in groups, but you've got to have a group of committed, you know, people that want to achieve the same thing, and you've got to have a leader that's prepared to jump in it. And that was really what we built together collectively with Calio back in, well, it's been 3 years now, so it's been live since October 2022. And really, it's a joint partnership between ourselves and the Calio team, and it's about getting results safely and simply. So for me, what's really important is that how do you build a globally diversified passive income and get portfolio growth? And we've spoken a lot about this diversification today across countries, currencies, assets, partners, and time. And it's about building your passive income and building your portfolio. And we follow a structured process. And what we've done between both of the companies is we've actually looked at what they do at the family office level, and we've gone, right, how do we help people go through this? And there's 9 steps that go through the entire process. And I would strongly recommend that you screenshot this, because no matter who you talk to in the financial industry, you should ideally be doing each one of these 9 steps. Now, I don't have time to take you through all of the steps, but I did want to refer to just a couple of things that Anthony and Garth were mentioning. The first one is that step 3 is the investor profile. And this is the Enneagram of Wealth, or better known as the Wealth EQ. And it's based on the Enneagram. It's the oldest profiling system in the world. It's been around for 5,000 years. And Karen, who owns her own business, but is also married to Garth, has been an Enneagram practitioner for over 20 years. And between the two of them, they've basically built the Enneagram of Wealth, or what they call the Wealth EQ. And there's 27 different investor types. Now, each one of those investors, like I'm an 8, you can see that there's a whole bunch of investments that I should be looking at, and there's core traits that I should be looking at. Then you look at the different investment styles, and it comes down to the numbers. And ultimately, you get a report. And imagine if you had a report where you knew yourself as an investor. This is what Anthony was talking to, where not only does this help the clients know exactly who they are, why they invest, why they've made mistakes, and what the best asset classes are for them, but also it helps the advisor really understand who the person is. And, you know, for me, there's so many testimonials we've had from people around how incredible this has been. But in simple terms, what does the Wealth EQ do? It helps our members gain clarity and insights into what motivates them, enabling a more effective decision-making process in investments. So we can come back to it, Anthony or Garth, if you want to add anything to it. The next step is step 4, which is the portfolio health check. And this is where Anthony or one of the team members will sit down. They'll look at your tax, they'll look at your structuring, they'll look at your current portfolio. I know that someone was actually asking in the chat, you know, would you help look at the portfolio? That's exactly what they do. I saw Garth answered the question. So what is a health check?
Can I interject very quickly, Scott?
Yeah,
I want to mention that 3-letter word over there. The one thing when people time the market and they get nervous and they jump in and out is every time you do that, there's a tax consequence and there's a cost to it. And that is one of the biggest eroders of capital and making bad decisions. Sorry, carry on.
No, perfect. So, you know, for me, a portfolio health check is similar to going for a medical health check. It'll help the members gain complete insight and clarity into their entire portfolio without massive overwhelm and anxiety, which enables the team to optimize the portfolio. What I find so interesting is the majority of people that Alex and I deal with and that we pass on to the family office, there's so much overlap and fees on top of fees and bad structuring and bad, you know, tax planning and everything in between. You'll be surprised how often people come back and are quite actually a little bit shocked with what they currently have, which takes us on to step 5, which is now the optimization. And this is something that when we do the wealth weekend, we spend an entire 3 days on this. But ultimately, if you're building a plan, it starts off with the wealth EQ. So we spend an entire day just on that. What is the wealth EQ? How does it actually work? Then basically it comes down to portfolio construction, which is what Anthony and Garth have already been alluding to today. How do you actually build the portfolio? And then finally, it comes to your life AIM. So this is your asset income model. Now, what does this look like? Effectively, and for those who are on the Know Your Numbers workshop, Anthony literally took people through not only how to do this model, but how to build it, how it gets constructed, etc. And each person would then have their own personalized model. And what I found absolutely fascinating when Anthony took people through it was that if you just took the average person and with an after inflation and kind of after costs and everything else, the average person, if they were getting a 6% return, would run out of money in the region of 85 to 86. At a 7% return, they would be fine until they were 99. And at an 8% return, they'd be leading, over $7 million to their family. And the question that I have, and for everyone, is who's managing your 1%? Because it's one thing to be able to do the planning, but it's the execution which is critically important. And again, if you want to watch that recording, I'm happy to share it with people. Just type in there or just AIM, asset income model. AIM. So what is portfolio optimization? We'll provide our members with peace of mind knowing they have a resilient investment portfolio. So I wanted to share this with you because Anthony and Garth have referred to it. Now you can visually see it. The final thing that I just wanted to share with you was that once you've got a plan, you need to have accountability. So this is where I work with our members every single month. And Anthony works with them on a quarterly basis and Garth on an annual basis. But ultimately, it's about what are the tools and resources? What are the mindsets? What's the execution to be able to get your results? And then finally, the step 8 is where every month, so it's actually happening tomorrow morning, where Anthony comes and he actually shares with us what do we need to know in the market. So this is an overall view, but on a monthly basis, it's it takes sort of 20 to 25 minutes. What do you need to know in the markets? And what's fascinating for me is that through our learning platform, we take people through that every month. Plus, I also bring in an expert every month to teach you on something new, some new asset class, etc. So you're learning the entire way through. So this is taking the plan and now it's executing on an ongoing basis in terms of that process. And so this is a monthly rhythm. It takes about 3 hours a month. And the last thing that we do in terms of the process is obviously we analyze deals. And Garth spoke about the German deal. Tomorrow we're looking at an industrial deal, but that's the process in terms of helping people. So this will help our members enhance their knowledge, invest in quality partners, empower them to increase their confidence and make better decisions for them and their families. And then ultimately, it's about investment. Through quality investment of partners, we enable our members to achieve results in globally diversified passive income and portfolio growth. And I've got so many testimonials. I'm not going to bore you with testimonials tonight. You can go and watch. This Cynthia said, thank God for the mastermind, the partners it brings us, and the exponential learning curve you gifted us. And there's so many videos. I'm not going to share all the videos. You can go and watch them. You can go and watch them all in terms of the process. But what I want to share with you in conclusion, and then we'll go back to the questions, is that I would strongly recommend, if this is something of interest to you, come and sit down with myself or Alex. Maybe Alex, if you could just put the link in there, diversificationmastermind.com. And we can sit and help determine for you which is the best level. Do you want to come in where you're the retail to sophisticated investor and it's mastering your portfolio? Do you want to come in with the high net worth, wanting to become a global investor with global diversification? Or do you want to look at generational wealth and ensure your legacy? And one of the things that we enjoy is the get-togethers and actually spending some quality time. And twice a year, once in March, once in October, we get together with a group of like-minded people from the mastermind. And so, also the buyers trips in London. So if you are interested in this, then reach out to us. The next one is in March. Stand to be corrected. It's around the 18th of March. And then I think around the 11th of October. If you are interested, you go to diversificationmastermind.com. There are 2 options. One is the priority option, where you can put down a deposit of $500. It's fully refundable, but you meet with me. So that's the priority option. And the second option is if you're not sure and you just want to chat it through, then you can sit down with Alex and he will assist you. But it's very simple. All you need to do is go to diversificationmastermind.com. And I assume, Alex, you've put it in the chat room for everyone. So I'll just click on the link quickly. So if I show you here, you can go, you can read, you can watch this video, and there's the 2 links, priority and apply. There's also an FAQ here if you want to go and see what it's all about and how it all works. And then finally, there's plenty testimonials if you want to go and look at it. Anyway, that's I just wanted to kind of give a bit of insight into what Garth and Anthony have been talking about. And someone asked earlier, how do they get access to it? Well, that's the way that we can help you. Anthony, in terms of the Wealth EQ, that for me is a game changer that no one else has. Like, it doesn't exist anywhere else in the world. Why does it make such a big difference for you as an advisor when you can really understand the individual and you're not just trying to put them in a box?
Yeah, it's that second layer. It's that one kind of step deeper into understanding a person. It allows me to tailor the way I give advice. And the reason for that is because I understand how that particular person likes to receive advice, right? Some people like pictures, other people like Word documents, some people like spreadsheets. There's certain areas where some of that is slightly unavoidable, but in general, it allows you to tailor the information to that particular client's needs, and when they're receiving that information, they can process it in a way that they want to process it, right? And that, at the end of the day, is not only beneficial for the client, but it's also beneficial for me because it means that the information that I'm giving to the person is understood. They get it, right? They can actually absorb it and take it all in. If it's not in a way that makes sense to them, a lot of that kind of key pertinent information can get lost. And I think that there's risk in that, right? You assume someone's on the same page as you, but maybe they're not. Maybe there's some kind of information that's lost in translation. So I think it's an incredibly good way to allow us to understand the person better. Obviously, that's just not on an information receiving level. There's multiple layers to it, but it's really about that deeper understanding and connection with the person that you're talking to.
Awesome. Garth, in terms of family office and kind of family office style thinking, it's really interesting. When I first met you through one of your clients back in 2013, 2014, I never heard of a family office. And I know nowadays people are starting to understand it a little bit more. But, the final 2 questions I've got here, and there's a couple in the chat room if you guys have time, but otherwise I've acknowledged we said 90 minutes. For me, in terms of the family office style thinking, when you talk about governance and structure and, helping investors build that resilient kind of multi-decade wealth, why is it so much value to come to a family office versus trying to kind of do it on your own? And just for the record, I love the analogy, Anthony, that you gave to one of our clients where you said it's like having a financial CFO like in your business, but like just explain a little bit more context around the family office and why it's so valuable for families to have as a partner.
Yeah, look, I mean, the vast difference is actually what Anthony said, that it's having a personal bank, a personal financial advisor, a personal financial director, chartered accountant, a private equity, a global structuring expert. Because what you want is a single point of contact. But what you also want is that massive collective experience. That's why Callio is not called Callio Group, it's called the Callio Collective. So the family office thinking gives you a center touch point, a single touch point, but multiple professionals to really, really give in-depth advice without having a financial advisor that outsources you to an attorney, that outsources and picks something that looked good on the internet. So this is tried and proven experience, global structuring, global tax, private equity, property experts, all in-house. So because it takes the wealth of several families, it creates a community in which opportunities are far greater than the retail market. So a lot of our opportunities are within the families of entrepreneurs that have exited businesses, started new business. So the power of the family office community, the access to the deals, the level of due diligence, the level of IP is just not available through a single contact bank advisor or a personal, a financial advisor that is an independent financial advisor, for example. He just doesn't, he's got to outsource that stuff. He doesn't have the resources to carry that in-house, and he doesn't have the multiple layers of intellectual property to really be able to consider everything from emotional investment behavior, enneagram of wealth, planning, asset consulting, life decisions, exiting a business, not exiting a business, and to have that depth of availability and that many people available to you at the same cost as your general advisor out there is, for me, a no-brainer.
Awesome. Thank you, Garth. And my final question to you, Anthony, is that my biggest takeaway, like literally probably my biggest learning lesson in 2025, was when you shared those asset income models and that massive difference between 6, 7, and 8. Like it wasn't 6, 16, and 26. It was 6, 7, and 8, and the massive impact that had on people. Talk to us a little bit about how important these return assumptions are and the risk assumptions, and then the timelines. And to some extent, what I think is the most important, because anyone can put anything into a model, the execution to get the result, because that's the most important thing.
Yeah. Look, the as you say, the return assumption is massive, and it's bigger the younger you are, right? And that all just relies on compounding. So the earlier you start, the more of a monetary difference that return will make over time. But it really is, it's the key driver of that life aim, right? As you said, it is an assumption. Now, that's where one needs to be very careful. You could, like you say, put in 15, 20, 30, 50%, and you're going to get the most amazing numbers that you've ever seen. You're going to be a trillionaire by the time you retire. So the importance there is making sure that the returns that we use are relative to the portfolio, the current portfolio, and realistic, right? If someone is 100% invested in an illiquid asset class, and you have an idea around what that return is going to be, you can't go and assume a return that's double that, right? Because in reality, you can't get out of that asset class, nor are you able to increase that return profile. So it's crucial to make sure that return is realistic and relative to the particular person's holdings. In terms of the optimization of that, that's really where the kind of analytical work is done, right? That's an in-depth process. It's an exploration process where we dive into the details of the current holding of that particular person, and we try and find ways to extract that additional return, right? Let's use a really crude example. Let's say someone is sitting 100% of their money in cash, right? That cash is earning 3%. We can make an assumption that the return on the life aim is maybe 10%. Why? Because we understand that we can get that money out of cash into markets, into private equity, into private credit, into structured products, all the nice things that we spoke about tonight, and we can increase the return profile as a result of that. So that's where that analytical kind of optimization side comes from, and it's crucial, right? There are often more often than not, times where small tweaks, small adjustments, small changes within the portfolio can better position you for future returns, right? Now, I use that wording very carefully. There's no guarantees. I'm not saying small tweaks can guarantee better returns, but there are usually kind of little ways to optimize portfolios that can have really big future ramifications in terms of increased return. And like everyone saw in those charts that you shared, that can create a really nice compounding effect over the long term.
So listen, there's a whole bunch of questions that keep coming in, and
I hate unanswered questions, Scott.
Yeah. So
I feel like doing some speed answering.
Yeah, I was going to say, let's do some like almost speed dating with them, because I've written them down here. I do want to just, for Sonia Warren and a bunch of others were asking questions about, how the family office works, how the mastermind works, how the fees work. Do me a favor, literally just go to this link, diversificationmastermind.com, book a call, either priority with me if this is what you really want, and you want to, again, it's a deposit, so you get in the queue, just like being priority on a plane or priority in private banking. It is fully refundable if we decide you don't qualify, or if we decide there's not alignment. And then equally, if you're not sure, you can just do the apply. Just go and find a time that suits you, Sonia and everyone else. We don't want to talk about it today. We'd rather talk about it in the one-to-one. So let's just go quickly back to here, and let's do rapid fire. So you did speak about gold and silver already, Garth, in terms of upside, and my take on what you said was it's obviously had a huge run, but you would still participate a little bit, is kind of what I heard you say.
Yeah, a lot of research. This is not our research, but there's a lot of research around it. I've got a lot of very good partners and, guys in the gold game. 18 months, it can still go 6,500, 7,000 per dollar, dollar per ounce.
Anthony, this was a question from Alan. He said, could you put up a chart on South Africa so we can compare? I know, obviously, well, I doubt you've just got charts available, but I think that would be a chart to compare I'm not sure, Alan, whether you were talking about the markets or the interest rates in terms of it. But I don't know if there's anything, Anthony, you want to talk to there. I know we spoke about it verbally, but I don't think you had a chart to it.
Yeah, I didn't have a chart, no.
Okay, this question was the one I tried to answer. So would the family, and Garth also answered it, would the family office be able to restructure our portfolio? That's exactly why I showed you how it works. So there's firstly a health check, like what do you currently have? And then there's portfolio optimization, which is where the whole asset income model and everything comes in. So the answer is very much so. That's 100% part of the plan. Can you speak of the very high levels of US and other government debt and how that would affect markets?
Sure. I think that's a Pandora's box type question. Yes, US debt is high. It's something that we're watching very closely. I think the whole world is watching it. Will they be able to get it down? I hope so at some point. Is it overly worrisome now? I don't think so. They've been kicking the debt ceiling up for quite a few years now. But it is a risk. That's for sure. It's not something that we're ignoring. But I think when you kind of print the currency that your debt is in, it becomes less urgent, let's say. High interest rates, I do think they've helped. Tariffs, believe it or not, have actually helped a little bit. So I do think you kind of see the US trying to put a lid on that going forward. But yeah, it's high. There's no denying it. It's high.
Perfect. Boom, 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 boom. Oh, how do you plan according to your age in current market conditions? That's quite an open-ended question, but
yeah,
okay, I can answer that. It's very simple. Okay, we don't believe that when you turn 60, that's an age, or 65 or 70. It's relevant to each person's plan, and capital is put into different silos to accommodate different cycles of the market. So you might be 65 today, require an income. There's going to be a portion of your income to provide a portion of your capital to provide income. You're going to have a portion which is a 3 to 7 year strategy, and you're still going to have funds which might be a longer. So it's all about that strategic asset allocation, and you will always have a portion that's not exposed to risk. Age is not necessarily, it's the quantum of capital and the plan against that quantum of capital that determines it.
Yeah, and I think Sonia, in terms of your questions specifically around the mastermind, I'll reach out to you, and or if you could just book a call with myself or Alex, I'd happily answer all your questions. And that goes for everyone else in terms of how it works. And I think the reason we like to talk with people one-to-one, two things. One is we want to understand what everyone is looking to achieve. Secondly, we want to make sure there's alignment in terms of how the best way to go forward is. And third, we want to explain how it all works and make sure there's alignment. So that's why we don't publicly try and talk about it. We talk one-to-one to make sure that we can help people make the right decisions. How do you plan? Oh, I've already done that one. Okay, Ben, you were asking about where the recording is. I will share the recording with everyone, but we will put it up in the Wealth University School Group, but I'll make sure it's available for everyone. And then this is one, Garth, that I know is very close to your heart, and it's a good one to finish off with. So I'm 23. So 23 is a perfect age to start. The sooner the better. And I know you always you spoke about it at the Wealth Weekend, if we could encourage our children to get started. So yeah, let's just finish on a positive with the earlier you get into the market, the better it is, basically. And firstly, congratulations to whoever the 23-year-old was. So I need to go find your name. Justin, dude, most of your peers are out in a bar right now, so well done to you.
Go for it, Justin. The earlier you start, the easier it is.
Yeah, and I know there's quite a lot of research out there that the person that started at 20 but then stopped at 30 will beat the person who like worked, didn't start investing and I don't remember exactly, but only started at 30 and saved for the rest of their life. Like they don't beat the 20-year-old,
Yeah. The person that saves for 10 years and has a capital base left from the age of 30 to age 65 has more capital than the person that starts at 30 putting away the money trying to play catch up. The power of compounding, and it doesn't matter how old you are, just start. Okay, you'll be surprised how quickly things can actually start compounding.
So let's finish, and I just wanted to say there's a great saying: if you want to go fast, go alone. If you want to go far, go together. So if you've enjoyed tonight, for me, this is all about wherever you are. And by the way, you guys didn't, before you came on, there's literally people from all over the world. It's quite incredible. But if you did enjoy it, hopefully you've learned the value of, the comparison with trying to do it yourself versus having partners like the family office on your team. And so we always finish with a bit of fun. What did you think of this session? Let's have some fun. We're going to write down 1 or 2 words and put it in the post. 3, 2, 1, go. So just type it in the chat box. We're always interested to see what everyone thinks in terms of the process. Garth and Anthony, thank you so much for your time. I really, really appreciate it. It's, a huge amount of value that you're adding to people that otherwise wouldn't be able to get access to it. And as Nelson Mandela said, money won't create success. The freedom to make it will. And I think the thing that I'm deeply grateful for is that you're prepared to come and share this knowledge with everybody so that they can make the right decisions for them and their family. So thank you for your time. I deeply appreciate it.
Thanks for having us, Scott.
Thank you. Thank you, everybody. Thank you for the kind words. Keep well.
Awesome.
Thanks, guys. Cheers.
And to all of you online, well done and thank you very much. It's wonderful to have you. I'm glad that you're coming and learning from the best. Let's make 2026 the year that you achieve the results. Do not forget this book. Where did I put it now? 10x is easier than 2x. And the simple biggest thing with this book is who, not how. So if you want to achieve 10x results, you need to figure out who your who is. And hopefully tonight we've shared with you a good example, joining something like a mastermind, getting the right people around you, working with a family office. That's a classic example of getting the right who so that you can get the results that you want in 2026. Have a wonderful evening. For those of you who've written in the chat box and asked for the asset income model, I will share it with you. Watch your emails. We'll put up the recording, and hopefully all of you can take this information, synthesize it, and execute upon it. Have a wonderful evening. Thanks, team, for setting this all up. Alex and the team, appreciate it a lot. Cheers, everyone.